and welcome. So, welcome to How Business Valuations Work. Knowledge is power and more than just EBITDA. Take it away.
Thank you, Jerry. We're here live from New York City on 32nd Street. Appreciate the opportunity to be with you, and thanks again for your patience as we got back online, and there was about a 45-minute delay. So thank you for coming back. All right, so today's agenda, we're going to talk a little bit about how I believe valuation knowledge is power and having more than just one number, which is an EBITDA multiplier. So what I'm looking also is to look at when would a certified valuation be important for you and your business. Also, we're going to look at the various influences of what a valuation calculation is made up of. We're going to talk about the asset, the market, and the income method. And we're going to share with you the cost of capital, which really is the risk of your business. And that cost of capital is used as the present value factor to determine your present values. Okay, also, there's several rules of thumb that I'm going to share with you about how mistakes are made, and I'm trying to help you to avoid valuation mistakes. Then we're going to talk about discounts, minority marketability discounts, and how that wraps up into the value of your business. Okay, normally if we were live and you were here sitting with me, I would find out your name, your company, your industry, your position, so that I would have a better idea of who the audience is, and I could help tailor that. In absence of that, then I would look at you all as an executive of some kind in your business with something to do with the financial performance of the business. Okay, I'm going to give you a little bit of my background so that it gives you some context of how I've come to speaking to you today. I started out my career as a chemical engineer. Worked for FMC, which is a Fortune 50 U.S. company. I worked in both the agricultural chemical and the chemical divisions in Pocatello, Idaho, and in Middleport, New York. I then moved back to Utah and managed Utah Power and Light's largest power plant, 400 megawatt system. Oh, after crawling in and out of boilers on call 24/7, I decided, hey, there's got to be a better life. So I went back to school, completed my MBA, and when I graduated, I became the first marketing director that Utah Power and Light ever had. I was in charge of business development and economic development and had the privilege of creating an 11-step process where employees could submit ideas and we would put them through this process to evaluate its potential. We actually created 5 subsidiaries from employees' ideas, and we gave up to 10% of the profits back to the employees. This was very innovative for a bureaucratic utility. In the process, in 1990, Utah Power merged with Pacific Corp, and my department was moved to Portland. I chose to stay in Salt Lake. I had 2 kids in high school and 1 in junior high, and decided not to tear up their lives. Since that time, which is 1990, this is my 25th year of helping turn around businesses, which I've had the privilege of turning around over 100 businesses. The real fun part as well is I've had the privilege of commercializing 50 technologies, meaning taking a professor's or an inventor's idea all the way to the marketplace. I've started up 35 high technology companies and helped those companies raise about $3 billion. I've had the privilege of also being an operating officer in almost every position that happens within a company. I have a certified valuation firm, Excel Management, in Salt Lake City, Utah, where we do valuations of all types of businesses for all kinds of activities, including stock options, equity shares, gifting, etc. I had the privilege about 4 years ago, I was helping to put together a merger of 2 half-billion-dollar companies. I was flying from Salt Lake to Philadelphia every week. And I got this delightful call from this woman who said, how would you like to be a CEO of a group of CEOs? And I said, wow, that sounds interesting. Who are you? And she shared with me that she was a representative of Vistage International. Vistage is made up of about 18,000 executives across 16 countries of the world. We have national speakers that come in every month. We do issue opportunity processing where you get the perspective of 15 or so people, and it helps you to get out of the trees and have an open opportunity to see somebody else's ideas of how to solve problems. It's a great group. and I speak to VISTI's groups all over the country. Okay, so let's talk about now a little bit more valuation. I'm going to give you some examples of where certified valuation really made a difference. So this first example is two pink sheet companies. So pink sheet companies are basically penny stock companies. And then maybe they merged with a shell to try and raise money. But what happens is they don't have float or transactions. These two companies were merging. One was buying the other. And their last transaction, maybe 6 months or 12 months ago, was to transfer their two stocks at 46 to 100. The acquiring firm decided to do valuations current on apples to apples basis. After that was done, for a little bit of fee of $15,000, they saved $5 million in their transaction. Okay, the next one is one of my CEOs that I mentor in Utah, and he had run out of capacity in his capabilities of fabrication, steel fabrication. And so he was looking for a business. When they first started talking, they talked about $4 million. And again, after doing some side-by-side valuations, the deal closed at $2.6 million. Intellectual property is an important element, possibly, of a company. Certainly brand and trademarks are. When you get a patent, the lawyer will charge you $25,000, $50,000, whatever it happens to be. Typically, that is booked in the balance sheet as an asset. However, the value of intellectual property is much greater and usually is the market share that that intellectual property will provide you. So if you just looked at your balance sheet, your patent would say $50,000, when in fact, it may give you 10 points of market share over your competitors. We would then do a present value of what that 10 points is worth, and that becomes the value of your intellectual property. The last one I like to share, because divorce cases happen every day. This husband and wife were trying to be very amenable with each other. They weren't trying to cheat each other, but they were going off the balance sheet. And each person's share was $180,000. After doing the 7 methods that I'm going to explain to you a little bit more about today, they closed the deal together at $630,000. So let's look at when valuations are needed. Obviously for a merger or an acquisition or financing or an investment, or if you have a privately held company and you want to gift some shares to your heirs, you need to know the valuation of that. How about a purchase allocation or a fairness opinion, such as the one that I explained with the pink sheet companies? Now, all 35 high technology companies that I helped start, we had stock options. We used to be able to give sweet deals to our stock options, meaning, let's say the value of the share was $1 a share. We could price it at 15 cents a share, and so that then an employee could purchase those shares very inexpensively compared to the value. Well, I'll tell you, the IRS frowns on that now. And so if you have stock options or you have an ESOP and you need to value your company every year of what the market is and not at some undetermined discount. Okay, for life insurance and shareholders agreements, and there's a conflict between value and tax. So I'm going to bring that up right now. Most privately held companies have what we call an owner's toolbox. The owner's toolbox allows them to expense, let's say, gray area items that would help create a zero tax. Well, a zero net income doesn't have much value. So you want to keep track of those toolbox items that are kind of a gray area expense so that you could add them back in. Let me give you an example. If you were an owner and you were taking a salary of $500,000 and the market salary was $250,000, certainly you're paying taxes on the $500,000, but you're also driving your business income to $250,000 less. Well, if you sold your business and you hired a CEO for $250,000, all of a sudden you'd be getting $250,000 of extra cash flow. You need to keep track of those types of expenses because you want to add them back into your net benefit stream or your net cash flow. And of course, you want to have a buyer-seller agreement, or if you're selling some equity shares or buying equity shares from family members. Now, as a chemical engineer, if we designed a distillation column to take heavy oil and convert it to kerosene, gasoline, and jet fuel, I knew exactly the number of plates, the pressure, the temperatures, which fraction would come off where, and we would be able to convert those to the liquid. Well, business valuation has exact calculations, but there are many variables that are highly dependent on the perspective of the appraiser as well as the company. Some of these include the purpose of the valuation, what are the market conditions, comparable companies, what are the risk factors of this company. I'm going to share a little bit more about risk factors. What are the business and economic history as well as projections? Believe it or not, just like a home, if your business doesn't look very clean or tidy, it's going to devalue the business. Now, management team is a little tricky. Most people think tribal knowledge of their experts is very highly valuable, when in fact, tribal knowledge of people is not very transferable. It's much, much better to get systems of where you are able to take that tribal knowledge, convert it into systems, because systems are scalable and they can then be reproduced. Tribal knowledge is actually a detriment in the valuation of a company. And of course, the business appraiser's perspective. Now there's three main methods that we want to discuss here. First, the asset, then the market, then the income. And then there's a bunch of rules of thumb that you can go on the internet and get that create multiples of errors, which I'm going to point out a few. First, let's talk about the balance sheet. If I was live with you, I would ask you, what could possibly be wrong with a balance sheet? Answers might include, how about our asset value? Obviously, we have depreciation methods that write off our assets as quickly as possible in order to save taxes. Well, that's not necessarily indicative of what the market value of your assets are. So we need to get your assets to market value. What else could be wrong with the balance sheet? What about inventory? Even if you are calculating your inventory daily, you still may have inventory that's out back that never moves. Well, that's dead inventory. It's on the books, but it may not be of value in any kind of transaction. So we need to understand your inventory. What about receivables? If you have accounts receivables, yeah, they're all listed there on the balance sheet, but what if you had 20% of them that were over 120 days? Well, most of those over 120-day receivables, unless you have a government contract or a GM contract that doesn't pay for 120 days, would be uncollectible. Or maybe you'd get 5 or 10% out of those. So all of those factors need to be adjusted as well as payables. So those are a few items of the balance sheet that get people in trouble when they go to value their business just on a balance sheet. Okay, let's look at the EBITDA multiplier method. Now, in the profession, there's a lot of fun accounting that can happen between revenue and net income. The EBITDA multiplier basically uses cash flow and multiplies that to value. In the profession, we like to use revenue multipliers. Almost everyone books revenue correctly, whereas net income can be manipulated in a number of ways. Now, we have access to 60,000 private transactions. We looked up transaction history over the past 10 years versus your SIC code, which is your standard industry code, or your NAICS code. So I can get a number that shows the number of transactions, the high, the low, the average, the standard deviation. So this gives a very positive indication of what has been selling in your specific industry over the past 10 years. So we like to use revenue instead of EBITDA because most everyone books that correctly. By the way, the database also supplies EBITDA and cash above owners and so forth. So there's a lot of other statistics, but for valuation method, we use revenue multipliers. All right, the most common method used is the discounted cash flow method, or the net benefit stream method. Now, I want you to visualize with me a hockey stick company. So they're growing a little bit for the first 2 years, and then they start making a hockey stick turn. If I took the average, by the way, we use 5 years of financial data, the average of that would be obviously lower than the top 2 hockey stick years. So if you take a historical company, great, that's great, but is that really the value of this company that's trending up high? What we do is we use statistical analysis to project 5 years out into the future. So we would use linear projection, exponential projection, power curve projection, maybe even logarithmic projection to analyze where you are going. We use the highest correlation factor, it's called the R factor, to actually project 5 years into the future. So now I have a history number. I have a history projected number. What if you had a step change? So let's say you were going to acquire a company, or maybe a private equity firm invested in you. You would have a step change from where you are now to the future. We asked management to supply us with 3 projections: a high case, an expected case, and a low case, with all of the assumptions associated with it. Now, just in the income method, I have 5 numbers. I can see what my history number is. I can see where I'm projected to go. I can see where my projections based on maybe knowledge that I may have gained internally, or I may have had an investment. So let's recap. We have an asset method. It has to be adjusted to become accurate. We have a market method, which gives us an average, a high, a low, a standard deviation. And now we have up to 5 income methods. I believe knowledge is power. By compiling and looking at all of these methods, you can see what would create a low value, what would create a high value, what would be the average value. So that, to me, knowledge is power. Now, everybody wants us to give one number. So there's some weighting, some other things that I will cover shortly about how we get to one number. But let's go back to risk. The current market for a debt loan is approximately 3.75 to 4.5%. Now, I like to tell this story to show you how drastic this interest rate is. When I moved from New York to Price, Utah, I found a nice country home that was on a creek bed. And by the way, Price, Utah is a desert. And so what I found is a nice home with cottonwood trees, a stream. Went to the bank and says, wow, I'm really interested in this home. And he said to me, oh, by the way, our interest rate is 19.25%. This was in 1981. So I paid 19.25% for my home mortgage. Well, I now just refinanced and I'm paying 4.15. So interest rate is not just the value the bank charges, is because they're capped with regulations and you are required to have collateral and so forth and so on. If you are doing an equity investment, then the risk factor is made up of these 6 elements that I'm listing here. First of all, we look at the risk-free rate, 20-year Treasury bond. Right now, that's about 2.72%. Now, the difference between equity and debt alone is 5%. Certainly, if you invest in a company, it's way more risky than if you had a debt instrument with the company and they were required to pay you monthly. That by itself is 5%. Now, what does the IRS say is a small business? It might shock you to realize that the IRS says a small business is 500 million in revenue or 500 employees. We didn't think that they were the same risk. We think a $500 million company is much less risky than a $5 million company. So we've divided that up into 14 different segments between 500 million down to $1 million. Now, industry. If I was to start up a restaurant, what is the likelihood of that restaurant succeeding? Well, stats tell us that within 5 years, 80% of all restaurants fail. That by itself for that industry has a risk of between 8 and 10%. However, if I was looking at a hospital, us baby boomers, I've just had 2 shoulder surgeries in the last year and 3 knee surgeries in the last 5 years. I'm a common visitor at the hospital. And consequently, they have a very stable clientele that's actually growing, and their risk is negative. So we look up the industry specific and see what the risk is in your particular industry. Now, what about your company risk? This is a proprietary matrix system. It's a 4x10, and we consider 10 elements of risk for your company. The first one is the management depth and quality. So do you cross-train? Have the managers been around a while? Are they novices? And that has a risk. This matrix has a 0.25 to a 1 with a weight of 1 or 2. What about the importance of key personnel? If you had a key manager who had a boatload of tribal knowledge and they were run over by a bus, Would your company survive, or would you have a hard time duplicating what they have? The importance of key personnel is not only key man insurance, but it's systemizing tribal knowledge. What that means is you extract from a person their tribal knowledge and put it into a system, step-by-step process by which how they go about their job, including passwords, how they get into their computers and so forth. The next element we look at is the stability of the industry. So how did you do in years 2009 and 2010 when the economy was very low? So that also is a risk if you are stable or unstable during an unstable economy. Then the next three look at your product line, your customer base, and your supplier base. If you only have one product that takes about 70 or 80% of your business, that's a huge risk if something happens to that product. What about your customers? I've seen across the country people who are dependent on government contracts, 50 and 60% of their business, when the legislature did not approve the budget overnight, their business dropped by 50%. So we look at your customer base and determine what the risk is of your customer base. How about suppliers? If I have one supplier who is in China, is that risky or not? Of course it is. We like to see 3 suppliers so that you have diversification of risk. Sometimes geographical location is important if you're in the restaurant business. If you're selling in the internet, not so much. Now the last 3 have to do with financial capability of the company. Visualize with me shark teeth. So let's say your company is high, low, high, low, high. Okay, you'd say, well, hey, I'm on a high spurt, I should be high value. Well, if I averaged all those for your history, it would be an average of the shark teeth. However, an investor or a banker will be looking at the lowest point of your shark teeth. So what I recommend you do is look at ways to smooth out your curve. So if you're having a great year, maybe you want to make some payables that would be due in the following year early to maybe reduce that peak a little bit. Okay, the next one is earnings margins. Our bankers are our friends. They have access to what's called Risk Management Associates, RMA. You can go to the banker and say, hey, I'd like to get an RMA report in the SIC code, the standard industry code that you're in. And believe it or not, the Risk Management Associates folks poll companies in all SIC codes. There's usually between 10 and 25 companies within your SIC code. And by the way, they do it in 5 million chunks. And this report will give you all of the ratios, their cost of goods, their net margins, their net income, all the balance sheet ratios, current ratios, inventory ratios, etc. So you can see how you do compared to other companies in your industry. And we look at that as well. Now, visualize the hockey stick again. If you're growing like a hockey stick, do you have the financial structure and capability to support that growth? Believe it or not, many people have died because they have grown too fast. Now, not personally, but their business. So it'll be the difference between payables and receivables and your cash investments that you're going to make for capital can drive a company to bankruptcy even though they're growing at large numbers. So we look at your financial structure. Well, if you combine this all together, this is a typical cost of capital. So in this particular example, the risk-free rate was 2.83, the equity 5. This was a small company, so it was 12%. Their industry was actually not very risky, so they had a negative number, but their company-specific risk was 7.5. So this gives you an after-tax cost of capital of 27%. This would be the present value factor that you would use on your after-tax discounts of your cash flow. Okay, I don't want to spend a lot of time on that. I just want to give you some idea that it's not the interest rate your banker would charge you to be your cost of capital. Okay, let's take a couple of examples of how you might create errors by using rule of thumb. If you go online and you look at what the cost of capital of a startup company is, they'll give you a range of 20 to 80%. If you look at a growth company, they'll give you a range of 15 to 40. How about mature? 10 to 25. If you just throw a dart and pick a number of your cost of capital, you can create significant errors in your present value calculations. Also, if you mix and match before tax cash flows with after tax discount rate, you'll make a huge error. Now, I told you that we use 5 years of financial history as well as 5 year projections. What credit do you get for years 6 to infinity or 6 to 20 in that model? The answer is none. So what we do is in year 5, we simulate selling your business and then we present value that back. That's called the terminal value. So if you go to your accountant and you say, hey, could you run my discounted cash flows of my last 5 years? You're going to underestimate your company by a significant margin, which I will share with you in a minute. Then there's also discounts and weighting that can create error. So let's go back to our 7 numbers, or maybe 9 numbers. How do we come up with the 1? Well, we look at the purpose, the quality of the data, the reliability of the data. Let's take your hockey stick example. If I looked at the hockey stick, your history might only be weighted 5 or 10%. However, the projection might be weighted 20 or 30% because, by the way, 3 years is a trend. Not 1, not 2, but 3 years. So we would project out, and that might be weighted more. Maybe your assets don't really apply. Let's say a software company's assets typically are next to 0. So that wouldn't have any weight or very little weight. We would be looking at the market method and the income method and weighting those based on reliability. Obviously, this is a variability within the science. The calculations of the discounted present values are exact, but there's assumptions that go into the present value cost of capital, and I've got 7 methods to weight. Now, what about if I propose to buy 10% of your business and it's worth $1 million? Okay, I'm a minority shareholder. I'm not on the board. I'm not an officer. I have no control. I have to just sit there and hope that you're going to make the right management decisions. Well, there's lots of studies on what discount would you provide for a minority position. It ranges from 14 to 40%. In my example, it might be 30 to 40% discount. However, what if I was a board member and I was an officer and I met with the company monthly? Then my minority discount might only be 5 or 10%. So again, it's situational, and it's the perspective of the appraiser with the CEO or CFO. What about marketability? Let's go to the same example. I'm going to own 10% of this company. When can I sell my shares? The privately held company. Well, I have to beg the owners after 20 years, hey, I'm not getting any return on this investment. Can I sell my shares back to you? Okay, if you're not on NASDAQ or you're not on the New York Stock Exchange, you don't have an immediate market. There's lots of studies that show that the discount is between 10 and 52%. Right now, since 2000, the average is 26%. And we also have done a study with 2 venture capital groups in Utah to discover an early stage discount if you're pre-revenue or just barely starting revenue. Okay, let's take some examples. We have a company that's growing from 5 million to 13 million in 5 years. Their net benefit stream is going from $500,000 to 1.4 million. If you miss your cost of capital by 10%, it results in an error of almost $1 million, $900,000 in this example. What if you miss it 20%? The error is 5 million because if your present value calculation is not a linear equation, it uses square roots and multipliers of power. So it's my message here is don't just throw a dart at your cost of capital. Determine your cost of capital for your business, specifically with the elements that I've explained earlier. Okay, let's look at another error. Remember that terminal value that I told you about? Okay, we use 5 years of financial data. What credit do you get for years 6 to 20? So if you go and ask your accountant to run your present value calculations of your last 5 years and you forget the terminal value for the same example, 5 million to 13 million, with a benefit stream of 1.4 million at year 5, you would make a $4 million error in the valuation of your company. So live from New York here, what I've tried to do is help point out different ways in which valuations are done, some of the common errors by which people make mistakes by not knowing these important points, and hopefully when you work with your valuation professional, you can ask the right questions to be able to get more numbers, which I believe is knowledge is power. Now, we have this open up. If you want to write in a question on the chat line, I'd be more than happy to answer a valuation question, and we'll see about what might come in. Gary.
Dale, it's great. Let's give everybody a minute to write some of their questions down so that you can respond to some of them. We have some extra time to do that because we rescheduled as we've done this. While people are writing questions, I can see a few coming in right now. Let me just remind everybody that the Better Way workshop and webinar series, this is the first of 10 presentations. Each one will take place same time at 1 o'clock on Wednesday afternoons in New York City. And what you can do is attend them and register if you don't know the links for all of the different topics. This has been a terrific topic because we deal with a wide range of business-related topics. Go to betterwayworkshops.com and click on the webinar section, and all 10 will be there with a description and a link. So if you haven't received the actual email advertisements that we've been sending out to people, you can do that. And with that,
Jerry,
you have a question? Let's go answer some of these questions.
Okay, so a question come up is, what does a typical valuation cost? Okay, if you use a Big Five or Big, I guess, 3 now accounting firm, it may cost you $20,000 to $50,000 to get a valuation. If you use a national valuation firm, it might be $10,000 to $20,000. There are local valuation firms that may charge $5,000 to $15,000. So my recommendation is to not only shop around, but to ask them what methods they use and how they come up with their one number. I've hopefully shared some thoughts on how to qualify a valuation firm as well as the money provided.
Great. Want to take that other question?
Okay, so another question about valuation is typically, how long does it take a valuation firm to complete their work? Well, I can speak for my firm. Is once we get the data, meaning we have a data sheet to get your 5-year financials and your contracts and so forth, we process that in 7 to 10 business days. Now, I've seen firms take 3 months. I've had Vistage members come to me and tell me that it took them 3 months to get a valuation. We pride ourselves in excellence in being able to deliver a quality product in 7 to 10 business days.
That's great. Well, listen, you put your website on there, Success Biz Now, and people can correspond with you directly, Dale, and answer your questions. If you have any other questions at any point and you forget, you can always send them to team at Presentation Excellence Group, which is the holding company of which Better Way Workshops is part of, and we'd be glad to get you the information that you'll need for in the future. With that, I want to thank everybody for your patience in coming back for the second presentation that we've done this afternoon. Again, we are recording this, and later on we will post all the recordings so that people can share this with other people in their companies. Clearly, if you're in a position trying to figure out the value of your company and use that for the benefit of all the people who work in the company and the investors and your employees, you can't go wrong by speaking to Dale because he's going to help you in the best way you can get. With that, I want to thank you and remind you to come back next week at 1 o'clock, same time, same station. We'll present. Actually, I'm doing the presentation on projecting a leader presence. When you make your presentations, it's not just about what you say and how you say it, but the trust value and the impact of you as a leader that you have on your audience so they'll continue to use you. So we'll see you next week, and thank you again for coming. Have a great day.